Hey everyone, Abdel Misa here. Look, the market just closed. Big day in the market, big surprise. So I wanted to cover what's going on today. So let's get to it. So here is what's going on, okay? So big surprise from the job front, okay? The expectation was for a loss of 7.5 million jobs, and instead the surprise was that we gained 2.5 million jobs. I have to say I did not expect this. I thought we would lose less, but to gain 2.5 million jobs, that was a big surprise, and that is why the markets today just like went crazy. Okay, so the S&P is up 2.6%. Russell 2000, which is the small cap index, okay, so it's more of a value, like there are a lot of cyclicals in Russell, so it's up 3.78%. So there is definitely a rotation that is happening a little bit from growth to value. So anyway, normally you don't see these kind of days like this when the market has already had a huge rally. But look, the surprise was big, and that's one of the reasons like we get these big returns today. All right, so one thing that I have heard is like a lot of people are saying, look, what's going on? How come the economy is so bad? How come the stock market is going up? And one thing that is very important to understand is that the stock market is not necessarily the economy. Of course, there is a relationship between the two, but the biggest difference is that the stock market is leading. It's supposed to lead the economy. So let me give you an example. So before a recession, typically investors start to worry, and then they start to see, hey, there is uncertainty here. We might be going into a recession. Guess what the stock market does? The stock market goes down, even though the economy is still creating jobs and the job numbers are going up. The stock market goes sells off in advance. The opposite happens at the end of recessions, where the stock market leads because you start to see lights at the end of the tunnel, and then investors starts to buy stock even though the economic numbers are bad and then we're still losing jobs, but the stock market starts rising early. So that's why the stock market is always leading. Now, on the stock market itself, okay, the S&P now is almost at 3,200. If you watch my videos, okay, and I'm including the link for one of the most important videos, I have made the case based on my personal opinion that the S&P can reach 3,700 by the end of this year. And we're talking here in May when the S&P was 2,900. Okay, so people thought like Abdel, like I have had discussion with multiple people, including very smart investors. Are you crazy? There is no way we can reach 2,700 by the end of this year. And guess what? We might, okay? So here is what's going on and why I think the stock market has been going up, and why the bearish investors have been missing the boat, okay? So the first thing is obviously there is optimism with the country reopening, so that's good for the economy. So it gives that optimism that pushes a little bit stocks up. But the most important is not that. In my opinion, the most important is the Fed stimulus, okay? So a lot of people called it the Fed brought in the bazooka. What bazooka are we talking about, okay? I think Jamie Dimon, the CEO of JP Morgan, he called it like the Fed brought in the entire military arsenal, and I agree with him. You're not just talking like lowering interest rates or like quantitative easing by printing money and then buying trillions of dollars of bond. No, the Fed went a step further. I mean, they're even buying corporate debt. They're providing indirectly like business loans to small businesses. So they are, in my opinion, they have done a fantastic job managing this crisis, because if they haven't done so, we'll be in real trouble, okay? Now, a lot of people ask, okay, with all this money printing, are we gonna have inflation, all right? So make sure to check my video on inflation, whether all this money printing is certainly a source of hyperinflation or no. I gave my thoughts, and It's a really interesting video, so make sure you watch that one. All right, next, besides the Fed stimulus, right, you got fiscal stimulus. We already have $3 trillion of fiscal stimulus. I mean, we're not talking billions, okay? These are $1 trillion. And guess what? There is more to come. The House has already approved another bill for $3 trillion. Now, obviously, that bill, the Republicans and Democrats are not on the same page, so we're waiting. Now, however, I have seen yesterday and today there is a news that maybe the next bill, the Republicans are okay with $1 trillion. So obviously, there's going to be negotiation. So we're going to get somewhere potentially between $1 to $3 additional trillion. So by the end of the year, you're talking about $4 to $6 trillion of stimulus. These are massive, unheard of numbers. Think about in 2000, at the end of 2016-17. Okay, when, or was it maybe a year later? 2017, when we actually got the tax reform, okay? All right, so we had a huge year in the stock market with the tax reform, but that was less than $1 trillion. You're talking here about potentially $6 trillion of fiscal stimulus. These are massive numbers and people underestimate the effect of that. And then the other thing that if you watch my videos that I have highlighted is, look, ultimately this is a health crisis, okay? And then for a health crisis, you need a health solution. And there are a lot of treatments being tested, not treatments and potentially vaccines, depending on what your view on vaccine is. Some people are for vaccine, some people are against vaccine, which I totally respect that. But we are working very hard on permanent solutions, and there are a lot of trials, okay? And so just imagine if we were to get a permanent solution by the end of this year. I think the market will just continue ripping higher, okay? So, so that's the perspective. That's the bullish case for the market, and thus far the tape or the market is playing out that way, all right? So what's the bearish case? What's going on the bearish side? Why have people been missing the boat? And in my opinion, for the wrong reasons, okay? So first of all, a lot of investors, okay, a lot of investors have been bearish. In fact, like even hedge funds titans have been bearish, and I put a link on a video when I discuss this matter. Usually when there is a lot of consensus, when a lot of investors are all bearish, the market tends to do the exact opposite, okay? And then when everybody is bullish, the market might do the opposite again and then sell off, okay? So in this case, we have been, like, a lot of people are sitting on cash, or they think that, look, this is not justified. How come we're dealing with one of the worst pandemics, the economy basically shut down, and how come we know that next year the earnings are going to be bad. This is a short, or like definitely it's not a buy, okay? And here is where I think I disagree with these investors, okay? So their biggest argument is a valuation argument. So when they look at earning next year, they are, well, listen, earnings are not going to be good next year. It's going to take a while to recover. This is not going to be a V-shaped recovery. And they come up with a bunch of letters like, okay, is it going to be a V, a U, a W, an L type of recovery? All right. Okay. So then they're looking at earnings for next year, and let's say earning for next year for the S&P are at $124, and then they look at where the S&P trade. They're like, okay, wow, valuation is expensive. You divide the S&P by earning, okay, and then the S&P is trading at maybe around like 22 times. The market is expensive, therefore it's not a buy. But here is where I totally disagree with them. If the game was about earnings for next year, yes, then maybe they are right. But when the stock market does not just look at earnings next year. The stock market looks at earnings and cash flow all the way to eternity. That's how you price a stock, okay? When you price a stock, you're not looking just as next year, you're looking at next year, the year after, and you keep going to eternity, and you're trying to estimate and evaluate cash flows going all the way into the future, okay? So we know that earnings next year are not going to be great, okay? And so then the most important is like what's going to happen after. It's not just next year. So think about it this way. I built a model, okay, so and I said, okay, you know what, let's go with these bearish people, and that earning next year is going to be at $124, okay? But then the year after, we're coming to, let's say, $162 in the S&P, which is the estimates by analysts. Now, if you discount those earnings and you take into account lower interest rates, okay, because we're, the Fed has cut interest rates, and then when you look at the 10-year, it's below 1%, okay? So you have to take into account the lower interest rate. Guess what valuation do I get to? I get to 3,700, okay? So the idea here is not about just next year. Even though next year is going to be bad, we have to look after next year, what's going to happen. Stock investors are used to this concept, okay? So there is something called non-GAAP earnings, okay? So for example, when companies have a one-time restructuring cost, okay, and let's say a company earns $1, okay, but then the restructuring is 40 cents, okay, so then earnings are 60 cents, so $1 minus 40 cents, okay, but it's considered a one-time, so then the non-GAAP earnings is 60 cents, okay, the non-GAAP earnings is $1 and the GAAP earnings are 60 cents. So which one would you consider? Most of investors will like, we're comfortable, we have to look into the $1 rather than looking into 60 cents because that was only a one time. But investors are not used to this from a macro perspective. You can look at this COVID crisis, assuming it's a big if, that we get a permanent health solution, that this is going to be behind us, that this is a one-time thing. Okay, so the next year is a one-time thing. No problem, it's going to be bad, but then after that we're recovering, okay? Here's another example for you, just to illustrate this point because it's really, really important. So assume that we want to buy a rental property, okay? But then rent for next year is limited to $1,000 a month because of some type of regulation, okay? There is a cap on rent. But after next year, rent can go to $3,000 a year. All right, are you gonna, when you're gonna price this house, are you gonna estimate based on the 3,000 or are you gonna price the house based on the 1,000? $1,000 is just 1 year, okay? So that's what's going on. In my opinion, just taking into account earning next year and calculating valuation out of earning next year is flawed, okay? But that's my own personal opinion. Now, of course, are there risks out there? Yes, there are risks, okay? In my opinion, we're gonna get to 3,700 by the end of this year, but there's a lot that can happen, okay? So we might have a restart of the China trade war. That will be bad for markets, okay? There is obviously election by the end of this year and then impacts on corporate tax rates and all of that. There are also, like, potentially, you never know, we might get a wave 2 of the COVID-19. Now, hopefully we don't want to deal with this. I think we're tired of this thing. I hope everybody stays healthy and then that's the last thing we want. But in case we deal with something like this, then that might be not such a good news for markets. However, on the other side, as I said, we might get a treatment. So we'll see what happens. Nobody knows. The future, nobody can tell you out there, yes, I know for sure. You can try to make the best guess estimate, and based on the data, based on the defensive positioning that I see, I do think there is still potential in the upside, but of course, look, there are risks and I could be wrong, but I still maintain my call that in my opinion, we can get to 3,700 by the end of this year. So I hope the video, it's a little bit of a new format. I just wanted, as I said, the market just closed. I wanted to give you my own perspective in kind of real time because we definitely had to deal with a big day today, big surprise. I hope this was useful. Make sure you watch the videos. There's a lot of content there. You know, I covered inflation, I covered the deficit, I covered my view on the market. So if you want to learn how to make money as a professional, there's a lot of content there. And also don't hesitate to ask me. Write comments, ask me questions. I'm happy, I'll respond. I'm happy to answer any questions that you have that I can answer. but please make sure to be active, write me comments, and I'll be happy to answer anything you might have. And so with that, thank you so much, and I'll make sure to see you next time. Okay, thank you.